What is free cash flow to equity? Free cash flow to equity, FCFE, represents the cash available to shareholders after covering reinvestment needs, interest payments, principal repayments, and other obligations. It is a key measure often preferred over dividends as it provides a broader perspective on a company's capacity to return value to its shareholders. Unlike dividends, which may not directly correlate with earnings or growth potential, FCFE captures the true cash-generating ability of a business. The calculation of FCFE begins with the net income available to shareholders, which represents the profit earned during a given period. Adjustments are then made to account for cash flow items such as capital expenditures, changes in working capital, and net debt movements. Capital expenditures, which include the purchase of tangible and intangible assets, are deducted because they are significant cash outflows. However, depreciation and amortization, being non-cash expenses, are added back. The net difference between capital expenditures and depreciation, known as net capital expenditure, indicates a company's growth potential. Higher net capital expenditure relative to earnings typically signals greater growth prospects. Working capital adjustments are also made, as they reflect the cash used in day-to-day operations. Working capital, defined as current assets minus current liabilities, can either increase or decrease cash flow. An increase in working capital implies higher cash outflows, while a decrease results in cash inflows. The working capital requirements vary across industries, with sectors like retail often requiring higher working capital compared to service-based industries such as IT or BPO. Debt repayments and new debt issuances are another crucial component of FCFE. The net debt movement, which accounts for cash inflows from newly raised debt and outflows from debt repayments, affects the cash available to shareholders. In some cases, companies refinance high-cost debt with lower-cost options, and these movements are reflected in the net debt adjustment. Hybrid instruments and preference shares, if used for financing, are also included in the calculation, with dividends paid to preference shareholders deducted and funds raised from their issuance added. The result of these adjustments is the free cash flow available to equity shareholders, which represents the residual cash that can be distributed as dividends or used for stock buybacks. FCFE is particularly useful for valuing high-growth companies, where dividends may not fully reflect their potential. For such companies, the discounted cash flow method often substitutes FCFE for dividends to provide a more accurate valuation, highlighting the total resources available for shareholder returns beyond just the distributed portion.